This video is recording of my own analysis of the company's financials, past performance, and future capabilities. I am recording to return to this in the future to check what I was thinking on the day. I am also open to any feedback, critique, and mutual discussion on my analysis. So today I came across this talk on a business channel. Let's take a look. The name is Welspun Corp.
तो हमें लगता है कि वेल्सपन कॉर्प इस पे ध्यान देना चाहिए। 2-3 की रीज़न्स अगर आप तीसरे तिमाही के नतीजे देखें और पूरे 9 महीने का परफॉर्मेंस देखें तो टॉप लाइन ग्रोथ तो ठीक-ठाक रही है, बट जो एबिटा मार्जिन परफॉर्मेंस रहा है, वो सराहनीय रहा है। दे हैव डन 13% तीसरे तिमाही में 9 महीने में 13% का एक कंसिस्टेंट ट्रैक रिकॉर्ड रहा है। पिछले वर्ष उन्होंने 17,500 करोड़ के आसपास की टॉप लाइन खरीदी विद अ मार्जिन ऑफ 10.25%। जो गाइडेंस दिया था उन्होंने ये वर्ष के लिए इंक्लूडिंग क्वार्टर 4 17,000 करोड़ की टॉप लाइन का, दे हैव डन 10,200 करोड़। मैनेजमेंट को लगता है कि जो टॉप लाइन है, एबिटा है और जो आरओसीज़ है, जो 15% में 9 महीने में और फुल ईयर गाइडेंस 20% का है, ये इज़िली सरपास करेंगे। व्हिच प्रोबेबली मीन्स जो Q4 के आंकड़े आ सकते हैं, ये काफ़ी शानदार हो सकते हैं। As far as Welspun Corp is concerned. Obviously, strategically, I think world's third largest line diameter company, जो स्पाइरल पाइप से बनाते हैं, डीआई पाइप्स बनाते हैं। यहाँ पे जो इंसेंटिव्स हैं, नल से जल योजना एज एन एग्जांपल, अमृत स्कीम, सो काफी इंसेंटिव्स है जिसकी वजह से इनकी जो ऑर्डर बुक है 15,000 करोड़ की, लार्ज पार्ट ऑफ ऑर्डर बुक इज थ्रू लाइन पाइप्स। ये सफाइस कर सकती है अगले साल की रेवेन्यू विजिबिलिटी को। जहां तक टैरिफ्स का सवाल रहा है इन टर्म्स ऑफ पाइप्स एक्सेट्रा, आई थिंक द बेस्ट पार्ट अबाउट वेल्सपन कॉर्प इज कि यूएस में एक बहुत बड़ा प्लांट लगा रहे हैं 350 केएमटीपी का एट ऑलमोस्ट 850 और करोड़ इन टर्म्स ऑफ इन्वेस्टमेंट्स, जो अगले वर्ष तक एक्शनेबल हो जाएगा। सऊदी अरेबिया में 600 केएमटीपी का 1600 करोड़ के इन्वेस्टमेंट्स के साथ ये प्लांट लगा रहे हैं। एंड दीज आर टू मेजर इकोनॉमीज जहाँ पे अच्छी खासी इन्वेस्टमेंट्स हो रही है, ऑयल एंड गैस में, वाटर सप्लाई चेन में और वाटर सप्लाई पाइप्स में। तो मुझे लगता है आई थिंक नेट फ्री बैलेंस शीट एक्सपेक्टेशंस ऑफ वेरी स्ट्रांग नंबर्स सो फार, कंटिन्यूएशन ऑफ दोस नंबर्स, जो ईपीएस आरएस रेटिंग इंस्टीट्यूशन होल्डिंग हम कैंसिल में देखते हैं, ये सारे पहलू ये स्टॉक फुलफिल करता है। तो वेल्सपन कॉर्प आपके वॉच लिस्ट पे जरूर।
So let's take a look at the price for this Welspun Corp Limited. Right now it is trading at 801 per share. It has a P/E ratio of 14, dividend yield is 0.6%, and market cap is 21,000 crores. So that makes it a mid cap stock. There is a Welspun Living as well. I'm not sure of the relation between the two. Maybe Welspun Corp is a holding company of the Welspun Living. It's a multinational company headquartered in Mumbai, specializes in manufacturing large diameter pipes and operates in multiple countries across 6 continents. Okay, so Welspun World is the parent organization of Welspun Corp, and it could maybe it's parent organization of Welspun Living as well. So if I look at the price history, it has a very volatile stock, to be honest. It goes up and down a lot. If I look at this portion, even in the bull run of 2007 2008, it went up a lot. It just went up straight. So from this low of 70, it went up about 8 times here, 6 or 8 times, 6, 7, 8 times, 7 times, and then it fell in the bear market to a low of 54. And since then it has been volatile, so the buyers shouldn't have fared well at these prices for a long time. Had you bought it after 2013 till 2022, you would have made a lot of money on this stock. But once again the stock has gone straight up, and that is a dangerous sign. Let's take a look at the PE ratio versus stock price. Let me change the color of this. So red is the stock price and blue is the PE ratio. I will change this setting from logarithmic to linear so that it's readable, and let's change this for long time. So here, when the stock price went up 7 times in the bull market of 2007 2008. The PE ratio also went up from 14 to 60. So PE ratio went up 5 times. And then when the share price went down, the PE ratio also collapsed from 60 to a low of 2. At this lowest point, it was close to 2. This time, the share price has gone up, but the PE ratio has not gone up. It is 12. 12 is a good PE ratio, but we will have to see if the earnings is sustainable or is it one-time earnings which will disappear. If that happens, if the earnings disappear, then the PE ratio will suddenly go up. It will sort up like it did here. But in this case, the price hadn't gone up a lot. From the lowest point of 62, it was up to 162. So this is Welspun Corp. It has a market cap of 20,000 crores. This billion is 100 crores. So if this is 20,000 crore, it's a mid cap stock. It's just on the border of mid cap and a small cap. It has a P ratio of 14, 3.5 times book price, capital structure of 20,000 crore, debt is 22 billion, that is 2,000 crore, 15, total enterprise is 21.6 thousand crore. So here for this 20,000 crore market cap, the sales is 14, or let's talk in terms of billions. For 208 billion, this is 145 billions of sale, and the net income is 10% of the sales. So if we can get this market cap below sales, then that is a good stock for me because it will be yielding more than 10%. So PE ratio in a sense would be uh, less than 10. In that case, earnings yield would be more than 10%. Right now the earnings yield is about 7% if I'm right. So Welspun Corp Limited, together with its subsidiaries, manufactures, sells and distributes steel pipes, tubes, bars, coils and plates in India, United States, Saudi and internationally. It operates through steel products. Okay. So it's in the steel. Welspun Living is in textile. So I was thinking it could be related to that, but this looks like this is manufacturing steel pipes, tubes, bars, coils. So it is in steel manufacturing and plastic product segments. The company offers carbon steel line pipes comprising longitudinal submerged arc welding, electrical resistance welded, high frequency welding pipes, ductile iron pipes, concrete wet and anti corrosion coatings. So it's basically manufactures stuff like that, pipes and steel products. Company was formerly known as Welspun Gujarat Steel Roden Limited. So let's take a look at the financials of the company. So here we have the total sales for the company. The sales have shot up in last 1 year. I don't know how sustainable that is. If we look at the history of the last 10 years, it's been volatile. It actually follows a cycle. The cycle is clearly there. So from 10 years ago, this is March 2015. The total sales for that financial year was 84 billion. Then it went down to 55 billion. From there, it went up till 99 or almost 100 billion. Then it went down to 63 billion, and now it's up to 173 billion. But if we see for the last 12 months, it's 145 billion. So it is cyclical, and it can come down to anywhere near 100 billion in next couple of years. That possibility will always be there. Then next, let's take a look at the gross profit margin. So it's not consistent. The lowest has been 26%, the highest has been 36, but that was just 1 year. For a couple of years it was 32, last year was 29. So it's around that mark from 26 to 30, let's say 30, 26 to 32%. And then net income margin is once again for last 5 years, mostly it has been around 6%. 1 year was more than 10%. Before that, it has been lesser than 2% as well. So it's really hard to predict. There is no consistency in the numbers. It's volatile. It will go up and down. Clearly, in the bull run or when the sales are growing, it will have higher margin. In those years when the sales are declining, it will have lower margin. So the best way to estimate its earning is to find an average of the last 10 years. So this is 6. So what is this? 2.5, 1.5, 3.5, and 6, 9.5, and 6.5. Let's say 9.5, 10, 16, 16 and 3, 19, 19 and 25, 44, 44 and 30, 74, 74 and 80, 90, 98, 98 and 40, 200, 140, 140 by 10. The average would be 14. So if you take the average earnings for the last 10 years, it will be 14 rupees. uh, so that would mean the PE ratio for the average earning of the last 10 years is very high. 10 would be 140, 280, 560, 40 times. So it's almost like 50, 60 times of the average earnings. From the current earnings, it's only 15 times, but the average earnings of the last 10 years does not give us the same confidence, because here as well the earnings went from 2 rupees per share. It shot up to 25. It remained at the elevated level for the next year as well, and then it came down to 7. So what can happen here is, it has in this upcycle it has shot up to 42, and then for the last 12 months it's 56. Maybe after that it can come down to 30 or 20 per share as well. That possibility will always be there. So even if we assume the low cycle average of let's say 25 or 30, even then this is more than 20 times or 25 times uh, the P ratio would be 20 to 30. Let's say 25, then 25 would be 250, 500, 750. So more than 30 times of the earnings. So let's look at the income statement in detail. We have our revenues here, and then there is cost of revenue, that is variable cost. If you subtract this is our gross profit, which we saw in the last tab. It was between 26 and 36%. So with this cycle it will go up and down. So why is this 102%? That is the growth. This is past performance. uh, we To look into what the company can do in the future, we would have to go into the annual report and look into the annual report, uh, especially the M&A, management analysis and discussion, MDA, management discussion and analysis segment. They may have put a few things about what they are going to do for the future. Then so see, for last year, from 173, 121 was their cost of goods sold, COGS. So gross profit was 51. From this 51, selling general and admin cost is not much. Depreciation and appreciation is seems to be consistent, and then there is a high other operating expense, and they aren't left with a lot here. So this 12, that is the operating income, 12 billion. So from 173 billions of sale, they are left with only 12 billion. So can I say if this goes down like it has done here by 12 billion, will they be able to save any money? So it has gone down to 145 in trailing 12 months period. This will include 3 quarters of the current financial year, which will be March 25. So whenever the results come in for this current quarter, it could be in April or May, then this will become the entire financial year data. Right now it includes the last quarter from this financial year. So it has maintained its operating income at 12 for now. But then we have seen that in the up cycle at the top it remains there for 2 years, and then it starts tapering off in the what is that cycle called, in the down cycle. Then it has interest expense, then there is income or loss on equity affiliates. That means it's on their subsidiaries, the companies in which they hold less than 50% of 50% of total holdings. In other words, they hold less than 50% of total shares. So it's their total earnings. If you look for the last 10 years, once again it's cyclical, it goes up and down. So there is no reason to believe that same pattern will not be followed in the future. If it does not, if it continues going up and up, that's all the good. But there is no margin of safety. If you look at the past data, it shows that this is a very cyclical company. The sales and earnings and margins go up and then they go down, and then it goes up and then it goes down. If I want to be safe, then I should be ready for these kind of years as well, where there's very little earnings compared to the current earnings. Then gain or loss on sale of investments, this is their earnings before tax. After the tax, this is their total earnings. This tax should ideally be around 25% of their total earnings. So this looks to be somewhere around 25% of this figure now. This is 20%, not even that much. So this is 33%. Tax expense of this EBT is 33%. This is less than 30%. This is 1 by 6, 1 by 5th, 1 by 5th. So 1 by 6 would be less than 20%. Once again, see, there is an increase in earnings before tax, but their tax expense has gone down. So in the income tax filing, they have shown lesser earnings than this figure. So for further analysis, we can dive deeper into their ITR filing. That would be up on their website. So basically, I don't know if this is good or bad, but what it does says is it's inconsistent. It goes up and down, so there is no surety that this earnings will continue in the future. The payout ratio is not very high as well. If you look at the history of the dividends for last 4 5 years, it's been consistent at 5 rupees per share which is not a lot. So let's take a look at the cash flow statement. They have their earnings, then their amortization and depreciation, other operating activities, change in accounts receivable, which is negative. So they are selling a lot um, on credit. Actually, if you compare this to their total sales, which was 173 billions, this is not a lot. Their inventory this year has gone down. So whenever it inventory goes down, this will be in positive because they have cash in store. When inventory goes up, that means they have converted their cash into inventory. So they don't have cash, they have inventory in that place. So their cash will go down. Change in accounts payable. When they haven't paid to their suppliers or employees or whatever, they have extra cash lying around. So this will go up. And then there's a big change in other net operating assets. So this is not a good sign once again. To figure this out, we will have to look into their annual reports in the consolidated financial statements, and we will have to go to the notes to figure out what exactly this is. Well, what I have seen so far, there's no margin of safety here. And then they have their cash from investing. Cash from investing, they have their capital expenditure last couple of years where they invested a lot in capital expenditure, and so their sales should go up in future. They're investing in marketable securities. So most of the year they had negative cash from investing, which is good. If you have a positive cash from investing, that would mean they are selling either their property, plant, or equipment, or they are selling their market and equity shares, and they would do that when they have shortage of cash. So that is not a good sign. This positive increase is not a good sign because here they have sold more investments. They were holding some equity. Uh, Either they were holding shares of other companies or they were holding bonds, and they have sold that to raise cash, even though they didn't had a lot of capital expenditure here, and they had positive cash flow from operations as well. If you look at this year, they had negative cash flow from operations, and then they had a big capex spending. So it's understandable that they sold their marketable securities to raise cash. But right now they didn't need to. Maybe they thought that the their holdings, the marketable price is going to go down, and that's why they sold. It's hard to say. So this is why we need to read the management discussion and analysis segment in the annual report that will contain all of these details or the thinking behind these transactions. Now next, there is cash from financing. So in the previous years they have issued a lot of debt, not so much this year. So 2 years they raised a lot of money from debt and they have gone back to their usual levels, and they have paid a lot as well. So sometimes what companies will do is they will raise new debt and they will repay the older debt. So that's why you have to check at the net change in debt. So total debt issued minus total debt repaid. So for this year it was their net increase in debt was 7 billion rupees. Here it was 13 12 to 12 billion rupees, and here this is a negative. So this year they have raised debt, they have actually repaid debt. So they've repaid, their debt would have gone down now. And then they have a minute amount of dividend payments. Their overall cash has gone down. Okay. So they had negative free cash flow for last 2 years. That was because of big capex spending. But apart from that, they have a positive free cash flow per share. And if you look at the historical average, this is around between 20 and 38, right? So let's take an average of around 25 and compare that with the share price. 25 is once again, share is selling more than 30 times of its free cash flow. So free cash flow yield is too low here. Let's take a look at the balance sheet. I will first look into the liability and equity side. The total assets has gone down. So it's sort of from this range of 76 billions to 150 billion, and then it has come down to 118 billion. If you look at the liabilities, most of it is total current liabilities. Liabilities had also shot up all of a sudden. Okay, so 30 to 80 to 40, there is accounts payable, then there is current income taxes payable. Unearned revenue had shot up, so somebody had already paid them money upfront for the work to be done, and that has come down now. So that's why that is recorded as unearned revenue, and in the asset side they might have cash for that. They might have cash for that. Long term debt, total liabilities. Okay, the total liabilities, 60% of that, 66% of that is current liabilities. They don't have a lot of long term debt or long term leases, so that's good here. um, and this retained earnings is a very good parameter to check. So it used to be around $17 billion in this period of 2015 to 2019, and then it went up a lot from this 17 billion. It has doubled in 5 years, 35 billion rupees. So doubling in 5 years at the retained earnings is a good figure. It shows the company is making money and retaining that money. Now let's go and check the assets. Once again, more than 50% of their assets are in current assets, which is a good thing. 43 to 96. So someone paid them money upfront. So someone paid the money upfront, and they converted that cash into inventory. So they had a lot of assets. More than half of that was the inventory, and that might have resulted in the increased sale for these 2 financial years. So this is 14. Is the cash receivable is 18. If you add these two, that would be 32, 33.5, 33, and then 23. So that would be 56. That's nearly total assets. They have inventory, they have cash, they have receivables here, equally divided. And then from net property, plant, and equipment is 44. Long term assets is not a lot, goodwill is not a lot. These two are these are not tangible assets, goodwill and other intangible. So always while analyzing, it's good to subtract this from the total assets. So here if we subtract this, it won't change a lot This will become from 118, it will become 115, so it's good. But for the assets of 118, it is selling at 208 billion rupees and giving me equity of 57. That includes, okay, it's not minority, it's it includes an equity of just 57 billion rupees. So if it comes down more, right now there's no margin of safety right now. It's selling at 208. Compared to total sales and total earnings for the last couple of years, it looks good. It looks not very expensive compared to that, but if you take an average of last 10 years compared to the total sales and total earnings, it's very expensive right now. There's no margin of safety, and if the same cycle continues in future as well, and there is no reason to believe the cycle will not continue in the future, it's wrong to assume that a company earning and sales will only go up and up and up. Sales goes up and down, especially for companies in the cyclical field. Some of the industries are more cyclical than compared to others, and this is in metal and mining industry, in material sector, and this looks to be very cyclical. So its total book value per share is 213. Let's take a look at the increase in the book value. So see, till 2020, everything was consistent. It didn't go anywhere, and from then it has double. The book value is double as well, and I was checking something else which double as well, right? So if you look at the free cash flow per share, no, not this. So what double? Retain earnings. Go back to the balance sheet. If you look at the retained earnings, it had doubled from 17, it had become 35 billion. And if you look at the book value, therefore, it had doubled from 106 per share to 213 per share. Let's say its book value will again double in next 5 years. So it will become 400 something, which will be half of what it is selling now, and then again it doubles in next 5 years. So in 10 years from now it will be four times, that is it will be around 800 rupees, and the share right now is selling at 800 rupees. So it's not good. I think analyzing this company with only the last year's earning would be a mistake. It's better to analyze this company with an average earnings and average sale of last 10 years or last 7 years. If 10 years is too long, w- we can ideally do a comparison of last 10 years, then last 7 years, then last 5 years, and that shows us a good direction of where the company has gone in the last 10 years. So it doesn't have a lot of minority interest as well, which is a good thing. The enterprise value is very close to the market value. So I'm not going to look into multiples and everything right now, because I didn't enjoy the financials of this company itself. I didn't like the financials of this company itself. So for me, multiples come after the financials. There has to be some consistency. Either the sales and margins have to be consistent, either they are growing consistently or they are consistent at a certain level. But this company has a lot of volatility in its financials. So the market cap of the company has to be at much lower level, especially in when the sales and earnings are at a higher level. That will provide a margin of safety. That means when the sales drop and the earnings drop, I could still be making money holding the company would still be profitable and it will be paying me money. However, if I buy it at a high price right now, and then when the sales decline and earnings decline, the owners of the company will not be earning any money and the share price could go down, should go down as well. So this is not complete analysis. We can go and look into the annual report as well. Let's take a quick look at that. Every company, if you visit their website, every company has this logo of great place to work. I don't think a lot of employees will agree that their company is a great place to work. They may agree in front of their managers, but in private they will not agree with this. So it makes pipes, makes steel pipes, steel. So pipes is everything I'm seeing so far. It's in Mandya. So maybe it makes pipes of different kinds of different material like steel or polymer or whatever. So ductile iron pipes, carbon steel line pipes, TMT bars and billets, pig iron, stainless steel and alloy water tanks. Also, all of their products are here. And the carbon steel line pipes, ductile iron pipes, TMT bars, pig iron. Pig iron is always a funny name. Stainless alloy and steel pipes, water tanks, syntax. Are they the manufacturer of these syntax tanks? UPVC interiors. About us. I enjoy looking at the website of these companies. I know the website is it's like marketing effort for them, but it gives useful information. It helps to know the company a lot just visually by looking at the photos and this infographic. It explains quite a bit about what the company actually does. So let's go to the investor segment. I will not spend a lot of time here. I just want to look at their annual report. Where is the annual report? This is annual return. That is the ITR return. I don't want to look into that right now. Let's go into financial results. So they have quarterly report here, annual report for last financial year. So see, this is a big report, 432 pages. You can't read the entire report. So you have to figure out which segments to look into. From page 50, this is MD&A. I want to take a quick look into this for 50 pages. And then from 215 to 426, there's financial statements, standalone and consolidated. So if you only want to do a quick look, you should go into consolidated, not standalone. consolidated statement includes the standalone, plus it includes the financial of the companies where this company holds more than 50% of the shares of those companies. So it will include everything. This company is in essence majority holding of majority ownership of this company has majority ownership of those companies. So it will include their overall financial and then will subtract a minority interest from the earnings. That gives a much more overall picture of the uh, true picture of these companies financials. This part, corporate overview, is more or less marketing on behalf of the company. So let's just chairman's message. What's unfolding? We'll quickly go down. I want to go down to the MDNA segment. So they are in Saudi Arabia and USA. I have to reach page 50. This is MDNA. So let's take a quick look at this. I'm not going to spend a lot of time reading this right now, as I'm not very interested in this company. So they are talking about their different products. Global economic overview. They are talking about global growth rate here. So I think this company is in an industry which is very dependent on global growth. So the growth of the industry will be similar to the growth of the average GDP. Now we'll have to take a look which other companies are there in this field. Given how cyclical it is, there may be a lot of competition, and that's why a margin of safety is important for this company. So the company itself is selling at 20,000 crores, and they have projects which are worth much more than their market cap. Once again, I don't want to go into detail, but this is good to read. Like by reading this portion of the annual reports, we can learn a lot about the world. All right, there's not a lot here, so I'm going to stop this right now. Looking at the my final analysis here is it's not a buy for me right now. I'm open for any feedback or critique on this, or if you want to discuss this in the comments. Let me know if you think looking at the financials of the company, if you think differently, or if you think I am on the right path or not. I think looking at the past performance, this is what happened in the bull run of 2007 to 8. It was at a lower level, then it went straight up in a very small amount of time, and as usual, it went down in some time. And the same pattern can repeat here as well. It has gone straight up, and then maybe in future it will go down like this. This is my analysis. Thanks for watching.